Trading your time for money won't lead to wealth, regardless of how much effort you put in. The limitations of the number of hours in a day prevent you from earning more. Moreover, you don't receive compensation for the time you spend resting, sleeping, or engaging in other activities. What if there was a simpler route to riches? Imagine if your money could generate wealth for you. It could be the ideal employer, without the need for rest, breaks, or a salary. Your money would tirelessly work around the clock, all year round, to increase your wealth. Thankfully, there are numerous ways to leverage your money to make more money. While you invest your 40 hours each week, your hardworking dollars will continue working tirelessly. In this video, we will discuss 5 ways to make your money work for you. Number 1. High-yield savings account. Before venturing into riskier investments, a high-yield savings account can provide a secure foundation for your funds. These accounts, backed by FDIC insurance, offer interest rates that are 20 to 25 times higher than traditional savings accounts. This means your money can continue to grow, while it awaits allocation and performs other tasks. Let's consider a scenario where you have an additional $10,000 and are unsure of the most profitable way to put it to work for you. Placing it in a high-yield savings account, with an annual percentage yield of 2%, would yield $200 in 1 year. Although it may not be a significant fortune, it surpasses the returns of a regular savings or checking account, which typically offer a meager 0.1% APY. In fact, leaving your cash in such an account would be similar to keeping it under your pillow. As financial planners advise, it's prudent to have a minimum of 6 months' worth of living expenses saved in easily accessible cash as an emergency fund, before utilizing surplus funds to generate more wealth. It is preferable to keep your emergency funds in a high-yield savings account, ensuring convenient access when needed. Opening a high-yield savings account is a straightforward process, often available through your existing bank. However, online banks, with their minimal physical presence, can offer higher rates to customers due to cost efficiency. Typically, they provide the most competitive rates by keeping their operational costs low. Number 2. Retirement accounts. The 2 primary retirement accounts that hold great significance are 401ks and IRAs. These accounts are investment-based, allowing your savings to grow exponentially in the market. The 401k is a retirement account offered by employers, specifically designed for individuals who may find it challenging to save money independently. Contributions to the 401k are deducted directly from their paychecks. By investing pre-tax dollars in a 401k, your taxable income for the year is reduced. To maximize the benefits of your 401k, it is advisable to start saving early and contribute as much as possible. Once you have established your emergency funds, the next objective is to optimize the tax efficiency of your 401k and invest your funds in the market to generate additional income. If your employer offers a matching contribution, it is wise to strive for the maximum limit to take full advantage of this benefit. After maximizing your 401k contributions, the next step is to consider opening an independent retirement arrangement, or Roth IRA. The difference between the two lies in the nature of contributions and tax implications. With a traditional IRA, you can contribute pre- or after-tax dollars, and your money grows tax-deferred. Upon reaching the age of 59.5, withdrawals are subject to taxation as current income. In contrast, a Roth IRA involves contributing after-tax dollars, experiencing tax-free growth, and enabling tax and penalty-free withdrawals after the age of 59.5. Irrespective of the retirement plan you select to build your savings, starting it early reaps substantial advantages. Beginning early allows you to leverage the power of compound interest, reinvest your earnings, and benefit from the compounding effect that leads to exponential growth of your money. For instance, if you make a single investment of $20,000 on your 20th birthday, and it grows at a conservative annual rate of 5% until you retire at 65, your initial investment could compound to approximately $90,000. Number 3. Stock market. Once you have maximized your contributions to your retirement plans, it is wise to explore the stock market as a means to grow your wealth. However, it is important to avoid timing the market or engaging in day trading, which involves capitalizing on short-term market fluctuations. A more advisable approach is a long-term investing strategy, often referred to as a buy-and-hold strategy. This conservative method involves acquiring securities like stocks, mutual funds, bonds, ETFs, and holding onto them for an extended period. By adopting this approach, your investments become less susceptible to short-term market volatility. As a long-term investor, you maintain your holdings with the expectation that the sector in which you have invested will experience substantial growth in the future. You endure and navigate through any new developments that arise over time, with the belief that your investments will yield favorable returns in the next decade or beyond. By allowing sufficient time, the market fluctuations should even out, resulting in an overall gain. Let's consider a hypothetical scenario, with an average annual return of 10%. An initial investment of $10,000 would grow to $25,937 over a 10-year period. Even more promising, if you add $5,000 annually to your portfolio, your investment could soar to an impressive $105,624 within the same time frame. There are other avenues for investing in the stock market to generate additional wealth, including index funds, individual stocks, target date funds, and real estate investment funds. These options provide further opportunities for your money to work for you and create more wealth over time. Number 4. Real estate. Housing is one of the basic human needs, and the demand is always there. Therefore, putting your money in real estate is a great way to get it to create more money for you. You can either invest in residential or commercial real estate. Investing in real estate makes money for you in two ways: appreciation and rental income. A property appreciates or increases in value with time, and you turn a profit by selling. When investing in real estate, bear in mind that property appreciation is fast-tracked by location, improvements, and development. Location is the most critical appreciation factor for a residential property. When facilities like transit routes, shopping malls, schools, and leisure facilities spring up around a neighborhood, the value appreciates considerably. The second way you can make money from real estate is through rental income. Your tenants pay a fixed amount monthly, which is known as rent, and this applies to both residential and commercial properties. Let's take a look at some of the actionable ways you can start earning from real estate. Flipping. Flipping is the process of buying a property, improving it within a short time, and selling it off to make money. To be successful in flipping properties, you must have an eye for viable properties, determine the underlying cost involved in improving the property to the desired level, and assess its potential value. You should also be able to fix them up yourself, or hire a renovation firm. Buy and hold. Here, you buy a residential or commercial property and rent it out. You can opt to manage the property yourself, or get a management agency to take the stress linked to being a landlord away from you. Vacation rentals. You can earn some money by renting out a house or room on a short-term basis. Companies like Airbnb have made it easy for homeowners and property investors to cash in on this by catering to travelers. This is especially profitable if your property is located in a well-known tourist destination. The demand for such arrangements is high, as many vacationers prefer it to staying in hotels. Real estate crowdfunding. This method of putting your money in real estate is especially suited for those who do not have much access to capital. Traditionally, investing in real estate requires a significant amount of money, making it the sole preserve of the rich and those with access to financing. But in recent times, crowdfunding real estate deals have taken off. It involves pooling resources together to invest in real estate. The best part is, you can start with as little as $100. There are many real estate crowdfunding platforms where you can own a piece of high-value property with just a tap on your smartphone. And number 5, business. You can make a whole lot of money by starting your own business, although not without risk. Putting your money in a startup can pay off handsomely. If you can't stomach the stress of getting a business off the ground, you can be a silent partner by investing your money in someone's venture. You won't have control over the business's daily operations, but if all goes well, you will share in the company's profits without breaking a sweat. In conclusion, your money can make money for you if you know how to use it right. These tips can all be classified as passive income sources, which means making money without exerting much effort. The best part about passive income is that you continue to earn once you set it up, even while you sleep. Sounds easy, right? However, they all require a significant upfront investment in time and money. That concludes today's video. I hope it was informative and beneficial to you. If you found it helpful, please give it a thumbs up. I welcome your feedback, so feel free to share your thoughts in the comments section below. Lastly, remember to subscribe and turn on notifications so that you don't miss any future videos. Thank you for watching, and I'll see you in the next one.